I believe you can see my screen. Can you? Is I want a lot of interaction. Audit is all about discussion. So everyone.
Yes, sir, we can see your screen.
Okay, good. All right. So when it comes to matters and evidence, right? Why do or why does your examiner ask questions on matters and evidence? Okay, so when it comes to matters, it is actually accounting matters. All right, the word matters is accounting matters and other related matters. So I'm going to give you the main overview, like what you are expected to know. Okay, some people just deal with three, maybe materiality, accounting issues, and risks, but sometimes the questions take a different turn and they are all matters. So I'm going to show you even specific accounting techniques, what can be wrong on the financial statement. So that's what we call risk-based audit. Okay. Usually when we talk about risk-based audit, it's just identifying risk areas and why they are risky areas of the audit. So in simple terms, what I mean is, okay, so if you have a particular transaction, there may be a potential that that transaction was never actually recorded, right? It never really occurred. That is one risk. So you are going to check for occurrence. It was never really recorded. You are going to check for completeness, right? The amount was not right. You are going to check for accuracy, right? An asset never existed. You are going to check for existence. You didn't actually own an asset. You are going to check for ownership. A liability is not actually yours, it belongs to somebody. You are going to check for obligation, right? An amount, an asset didn't have the right value. You are going to check for valuation. So usually these assertions also help us to determine risk. Do you understand? So why are we learning matters and evidence, right? We are going to learn that to know how to highlight key issues like risk or areas requiring particular attention or judgment before some specific procedures are actually designed. Often this will arise in planning or acceptance phases, and sometimes too the overall review phase. You know, you have to review the overall financial statements. Are you getting it? Before your final audit report is sent, okay? That is before you have something we call a closing meeting or a reconciliation meeting. Sometimes we do that in real life. Okay, in my work as an auditor, that's what we usually do. So we look at the overall review. Sometimes we do analytical procedures and other stuff. And this one is literally like what we do in real life. So what are the key aspects that you are going to focus on? It doesn't mean that every question you have to do all, right? But this is the general thing you need to note. So anytime you have a matters and evidence question, the first thing you have to focus on is materiality. Okay, so there will always be a particular accounting issue. Even if it is not an accounting issue, it may concern going concern. It's still an accounting issue of some way, right? But there will be a risky item. And you know that audit is all about materiality. So if something is risky, you must first check whether it is material. And what is materiality? We said something is material if its omission or misstatement is going to influence the decision making of users. So there are some things that, by their nature, they are always material, whether they meet the threshold or not. So something like directors' fees, you know, it can easily be manipulated because directors can pay themselves a bigger amount. Since the auditor, has been brought by the shareholders to check the directors, something like directors' fees is very material. So we have some things like large and unusual questionable items. These things are mostly always material. Okay, so there are different kinds of things that by their nature and by the nature of the entity too, it can also tell you some things that are material. But for now, we'll deal with the general materiality, right? Good. Now, the first thing is that when it comes to materiality, you must first discuss the calculation of materiality and the implications for the audit scope, meaning what you are doing, the scope of the audit, the coverage. Then the next thing is where you deal with the accounting treatment because okay, you have seen that R&D, right? R&D was wrongly capitalized. Research is supposed to be expense, but it was wrongly capitalized. Okay. And it didn't meet the development criteria. Okay, first find the figure. Okay, I'm going to teach you various ways to actually apply materiality the right way. Some people they just pick anything and say, okay, R&D capitalized, and they'll say, okay, a percentage of total assets. No, it doesn't work like that. There's a time you can compare it to the percentage of total assets. There's a time you need to compare it to the percentage of profit before tax, right? We are going to learn all that. Okay, I'll take it step by step for you to really understand how these things are supposed to be done. All right. So once you understand materiality, you have to go to the accounting treatment. This is where you are going to deal with what recognition, measurement, and disclosure. So sometimes it can be what an improper recognition, wrong recognition. That's the end result, right? Or a wrong misstatement or inappropriate disclosure. Are you getting it? Wrong measurement. So usually these things that mostly happen may be a change in accounting policy or a change in accounting estimate. All right. So you have to talk about all of that. So you are going to identify complex, unusual, or new accounting issue in the scenario and the IFRS or IAS principles that apply. Even if you are not so strong with accounting, at least you should have the basics of reporting because they know that, right? That's why you have to do corporate reporting before audit. But even if you haven't done corporate reporting, there's a back door, right? You must understand the general, even if you don't understand, you don't know the exact standard, you must say in accordance with the relevant accounting standards or accounting principles, right? And this will always be linked with a risk of material misstatement. So from there, you come and talk about the risk. So you are saying R&D was wrongly capitalized for example, right? What does the IFRS say? The IFRS says that R&D should always be expensed in accordance with IAS 38. There's a risk. See, let me ask the whole class. A risk, okay, has happened, but when we talk about risk, we are talking about risk of material misstatement. The risk that the financial statements will be wrong due to either improper recognition, improper measurement, or inappropriate disclosure. Okay, so let me ask you something here. If something that is supposed think from ethics, if something that was supposed to be expensed was capitalized, who can tell me why that would have been done and what misstatement that would be? Uh-huh. Something that was supposed to be expensed has been capitalized. Think like a fresh accounting student. What is the implication of the account? Something that was supposed to be expensed was added to assets. Yes.
It's going to increase the assets.
Okay, it's going to increase the assets, but what is the other side of it? Apart from increasing asset, expenses are going to decrease,
They are
and
going to
expenses,
P&L. So
yeah,
your expenses will be decreased, which
uh,
will increase. So here your profit is going to increase.
yes, your profit is going to increase. From an ethical point of view, why do you think somebody might have done that? This might be a competence problem. He didn't know. Do you understand? True or false? It's either the person
True.
didn't know or the
Yeah.
person did it intentionally. Do you get what I
Intentionally,
mean?
yeah.
If
Yeah.
he did it intentionally, then the mindset behind it would be like, okay, this guy did this because maybe they are going for a loan from the bank. Do you understand? So he wants to the banks want rich asset base. He wants to enrich their asset base and also show good profitability so that they can go for that loan. So the intent behind it will lead to a breach in objectivity and integrity. Maybe because there's pressure from management, are you getting intimidation threat? Or it's coming from self-interest. Maybe they've promised him some bonuses or something if the loan is easily got from the bank. Do you understand? You see, all these things tie up to ethics. So, but people don't bring the ethical issues when it comes to
Okay.
matters and evidence. Do you get that thing?
Yeah. So,
Yes.
so
So,
sir, please,
mhm,
a question.
yeah.
So, meaning if you even state the accounting principle behind it, you should link it to ethics.
Of course, because that thing
Oh,
that is wrong, there is an intent. Either the person did it intentionally or unintentionally. If he did
okay.
it unintentionally, then it's a competence problem. And competence problem is usually from either lack of proper training, lack of time, lack of information, or lack of resources. Do you understand? And the main
Yeah.
reason why an accountant will be interested in the main reason why you employ accountants is because of their competence, not because of objectivity and integrity. That is what I want students to always understand. Obia nko employ accountant say odi no krenti no employ no meboa. On your CV, do you put there you are truthful? Who cares?
Dabi.
It's
Dabi.
when you are working there, we'll check whether you are truthful and you have objectivity and the rest. So the main
Purely competent.
fundamental principle is competence and due care. That is the first thing we employ accountants for. So I always tell students that if you really want to be good at what you are doing when it comes to ethics, the first thing you should consider for an accountant is competence. Because no matter how truthful you are, if you don't have the skills, I won't employ you. Do you understand?
Yes, sir.
Good. So now, are you gradually getting it? So once you identify the risk, the simplest way that they tell people to do, if you are not you are not at the high level, that is where you look at it will lead to what? An understatement in expenses and an overstatement in assets. That's how you deal with risks, right? So this is where you highlight specific inherent and control risk relevant to a particular area being discussed. All right. But one thing that you must understand is this: it is not easy to spot inherent risk and control risks directly, but you see risk of material misstatement, like what those inherent and control risks have done to the financial statement. Do you understand what I mean? So sometimes they bring inherent risk and control risk in cases and student cannot identify them. So let me give you the simplest way to identify this. When we say inherent, let's come to inherent. Inherent just said etare ne ho meboa. True or false? Those who
True.
understand tree. So something that is inherent, it is tied to your business. So if I'm in a tech business, okay, I sell computers. There's an inherent risk, which is what? Inventory obsolescence. It is easy for my inventory to go out of fashion. And trim. True or false? Do you all agree?
True. True.
This risk, yes, can be a business risk, but it's still tied to the nature of my business. There's nothing I can do about it because so far as I'm in the tech field, these things are likely to what? To happen. And it is
To happen.
difficult to set controls for these things, right? Because they are inherent. If I have a complex group structure, then definitely there will be reporting issues. Do you understand?
Mm.
If I have several branches, then there will be accounting mishaps because somebody can buy something from this branch and return it to the other branch. Can I solve it? Yes, I can solve it, but it will be difficult because of the nature of the business. When we say inherent risk, that's what it means. It is tied to the business. Do you get it? And control risks are the risks that people can easily bypass your controls, or your controls are not effective enough to identify errors. Are you learning something?
Yes.
So these things, if my controls are not strong enough to identify errors, right? Then that means that the person who is supposed to identify the error, there's something wrong with the person, or there's something wrong with the system. So anytime control risks are getting a high, that means that these things are low. I use the word crime. So either your control activities are poor. The control activities are the activities management has put in place to check that they are not what risk in the system.
Yes, yeah.
Like if people buy inventory, is it properly authorized? If you are going to spend some money, is there segregation of duties? Are you getting it? Are asset properly locked? Cash, is it properly banked? Are you getting it? Computers, are there passwords? Do you understand? Then we have risk assessment. You often assess yourself for risks. We have what? Information system. How does information flow within the organization? If these things are done well, you won't have control risk, right? Monitoring. How often do you monitor for risk in the system? Then we have control environment. What is the attitude of management? Assuming somebody bypasses a control, is it punished? If somebody doesn't clock in today and he sends his friend to clock in, is it possible? How is management strict about the controls in the organization? So when these things are high, control risks are low. When these things are low, control risk will be high. Does it make sense? So when we say risk, inherent risk, some people think audit risk. When we say audit risk, that means inherent risk, control risk, and detection risk. How many of you have seen this before? IR plus CR times DR. How many of you have seen this before?
Wow.
If you are doing advanced audit, you've seen this before, right? Inherent risk by control risk by detection risk. You've seen that. Now, you see these inherent risk and control risk, sometimes it's difficult to identify them. So we call them risk of material misstatement, right? They lead to either improper recognition, measurement, or disclosure and presentation. That means there'll be a mistake with this because of this inherent and control risk. If you are, just like I told you, I'm in the tech industry, right? So most of the time, the inventory is obsolete. It easily goes out of fashion. Then you can tell me that on my financial statement, what will go wrong? Inventory is supposed to be measured at lower of cost and NRV, right? So if things are always passing, it may be possible that I'm recording at cost instead of NRV. Inventory will be misstated or possibly what overstated. Do you understand? That is the risk that inherent risk is going to cause me. So that is the end result the student is supposed to recognize. But sometimes they hide that aspect. But don't worry about it. As we go along, you will get it more. Do you understand? All right. So that is the thing. Now, this detection risk is not the fault of the entity. Detection risk is the fault of the auditor, usually because of two things. Either the auditor chose a wrong sample or the auditor chose a wrong procedure. Okay, so it is actually a sampling risk or procedures risk, which we call a non-sampling risk. And let me explain. Sometimes too, the entity can play a part by what we call limitation of scope. That means if the entity doesn't give you the right information you need, or they limit the amount of information they are going to give you, you are going to what? Face limitation of scope. They've limited you. They didn't give you the information you needed. So that can also lead to detection risk. For instance, if the client has a secret warehouse where he stores third-party inventory, if he doesn't tell you, how will you know? Please, I'm asking the class.
Of course, you already know.
You wouldn't know. So won't that create a detection risk?
Definitely will.
Definitely will. So are you getting the whole equation? So we are saying that, okay, there's a relationship between these three things, okay? That when these things are usually high, detection risk will be low. Why? Because if I know that this company is very risky, then I'll increase my eye. I'll be more alert. True or false? True or false? Because already I know that, look, this equation that you see here, people don't apply it the right way. Let me explain. If I know that this company is risky, that means they have high control risk, high inherent risk, then it is obvious to spot errors, right? So you can say detection risk will be low. Do you all agree? Because if I know that this place, there are bad boys here, when I'm going, I already know there are bad boys there. But what about an area where there are no bad boys, but something bad can happen? You have to be more alert there rather. True or false? So a company that has low inherent and control risk, that company rather you have to increase your detection risk. Why? Because you cannot easily spot errors. So you have to be on the alert. That's where you increase professional skepticism. Do you get the whole equation now? Does it make sense? Oh, please, it's a discussion. Audit is all about discussion. Once you get it, it will be
Yes,
you
please, it
know.
does.
Good. That's fine. So once you are
Please,
able to,
what was the question you asked that you use the detection, inherent risk and detection risk?
you know what is the question?
Yeah, I mean, what was the question you asked before you used that to?
No, I was saying that there is a relationship between them, all right? That when a company has high inherent and control risk, detection risk will be low, meaning that when it's obvious that this person has a lot of risks, it is easy to detect things, right? So it is lower. But when a company has lower detection and control risk and inherent risk, then detection risk will be higher because it is difficult to spot some things.
To
I mean,
identify. Okay.
yes, that's what I was saying. All right. So once you have been able to deal with risks, so usually most questions in ICA, students only get here. So they lose some marks. Because sometimes when the question comes under matters and evidence, sometimes they may ignore maybe the risk part and bring assumptions and estimates. Okay. So usually, sometimes you have to learn how to audit estimates. Okay. So if the scenario involves significant management judgment, so we have something we call judgmental areas. There are some areas on the financial statement that always requires the use of judgment. Something like provisions. Are we okay? Something like fair value sometimes. Are you getting it? So there are so many areas that require the use of judgment. Okay. So you have to discuss the need to assess the reasonableness of the underlying assumptions that they use to do that what? That judgment. Okay. Okay. Then going concern. If you are doing matters and evidence question, there are indicators of going concern risk. It will be a crucial matter. You are considering matters that are important to your audit, matters that are important to the financial statement, ethical issues. I told you always that so far as there's a risk, it is tied to ethics as well. It's either the person did it intentionally or the person did it what unintentionally. You remember. Then specialist involvement. Do you need a specialist? If there's a need that the thing has happened, let's say this issue you were dealing with had to do with the valuation of inventory or inventories, the valuation of a specialized equipment. Would you need a specialist? Won't you need a specialist? I'm
You
asking
will.
the question.
You will. You
Yes,
will.
you will definitely need a specialist. So you must tell the examiner. Students will not remember this. I'm telling you. So this area, once you understand it, you understand most of the components of the audit exam. So we are saying that okay, so when an auditor's expert is required, you must tell the examiner that due to the nature of this thing, the management will need what? Or the auditor will need an expert's opinion or will need an expert's competence in terms of what the work that the expert is supposed to do. Okay, then the impact on the audit. This matter that you have considered, how would it affect the audit report overall? Do you understand? Because if something is wrong, definitely it's going to affect it. Let's say they didn't give me enough information. This will lead to me issuing what? An except for limitation report. Do you understand? Opinion on the report, which mean I have to issue a modified report. Anyway, so the whole thing is that when you are writing a matter, okay, for example, you have to talk about the issue or the topic at hand, link to the scenario and the audit implication. That's the simplest thing, but you have to go through all this. But how do you remember this? Always start with materiality. How material is the thing? What did the IFRS say? Are you getting it? So, like, what did they do wrong? What did the IFRS say? Is it material? Are you getting it? What has it led to an understatement to overstatement? Then you consider other matters like ethics, going concern. Are you getting it? If you need a specialist and so on and so forth. Do you understand? Okay. So now let's look at materiality. Materiality is very important because some people usually don't know how to apply materiality. Let's look at it in detail, right? So materiality is assessed using benchmark percentages depending on the entity side, nature, and profitability. I told you earlier on. So in the advanced audit and assurance exams, you are going to use the ISA 320 thresholds unless the situation or the scenario suggests otherwise. All right. So there are some common benchmarks you have to understand. So usually profit before tax, right, is between 5 to 10% of profit before tax. Usually materiality, just use this one, right? The one at the other side, because this is the threshold from lowest to highest. Always use the highest. So if you see 5 to 10%, are you getting it? So when the entity is profit oriented, for instance, if it's 10 million, you can take 5% of 10 million to check the materiality. There's something called performance materiality. Are you getting it? We'll come and talk about that one too. So let's say I took 5% of 10 million. That's the materiality threshold from here to here. So I can usually use just 10% of profit before tax to check whether the thing is material. So let's say that assuming I have something worth 20 million, right? I can just calculate the 5% of the profit before tax. 20 million, let's say 2 million. 5% of the profit before tax, which is 500,000, right? This 2 million is above this 500,000. So is it material or it's not material? Is it material or it's not material? Is it material or it's not material? Do you not get the question? I told you audit is discussional. Do you get what I mean? Why is the class quiet?
We have to unmute before, so sometimes it takes time. But it's material.
When we say something is material, this is your threshold.
Yes.
5% of this 10 million, for instance, and that is 500,000. That
500,000.
means this is your benchmark, this is your target. So
Yeah.
anything that goes beyond this 500,000 is material. That's what we mean.
Yes.
And when we say something is material, it means that you should put eye to it because it has gone beyond the minimum threshold. This is the minimum threshold. Anything this or beyond has to be checked. So if this is the threshold and you have 2 million, is it not above 500,000?
Way above that.
So you have to investigate. Do you understand?
Yes, sir.
Good. So this is mostly for profit-oriented entities. Now, if you are looking at a percentage of revenue, you see, I'm also showing you where to use it. We don't just pick it. So usually when profit is small or fluctuating, or you have a high volume, low margin, or high volume, low margin businesses, okay? So let's say businesses that sell a lot of quantities at small prices, then you can use a percentage of revenue as the materiality. Do you understand? We don't just pick it to. Are you getting it? So most people, they just have the threshold, but they don't know where to use it. I hope you are learning something. So if it's profit oriented, like it's profit dependent, or they make major profits, then you can take a portion of the profit. I get it. And even it depends on the item, whether it's a P&L item or a balance sheet item, then you know what to take over, right? But if it is high volume, low value businesses or low margin businesses, then you can take a percentage of revenue. So let's say 1% of revenue, right? Total assets. Asset heavy businesses like real estate investment companies, you can take a portion of what? The assets, or even if the thing is a financial statement asset, let's say debtors, right? You can take a portion of total assets. So for instance, if the debtors figure was, let's say, 300 million, right? And you have 500 million. If I take 1% of the 500 million, let's say this was 3 million, sorry. 1% of the 500 million was for 5 million, and this was 3 million. Is it material?
No.
No, it's not material, right? But what if it was 30 million?
It's material.
It's material. Do you understand? Yeah, some people also use the percentages. So they will take the 3 million out of the 5 million and multiply by 100 to see what percentage that was. Whether it's more than the 1%, but this is definitely less than the 1% of the 500,000, right? So 3 million out of the 500,000, the 500 million, to see if it is material. But I prefer you find a threshold and put it down that is more than the benchmark or less than the benchmark. Do you understand? So let's do a quick recap. When do we use a percentage of profit before tax? When do we use a percentage
When
of
it
profit
is
before tax? Profit
when it
heavy.
is profit oriented.
Okay, profit heavy or
Yeah.
profit oriented. Where do we use a percentage of revenue? When the businesses sell a high quantity, low volume, low value, right? Or low profits. Okay, so that's when you use that. When do we use total assets, percentage of total assets? When it's asset heavy, okay? When percentage of equity, when equity is stable and reflects the scale of the company, you can use that. And it also depends on the item I told you before. So when it comes to percentage of net assets, that one you can use when it's not profit driven most of the time, right? You can use that, but it also depends on the question anyway. So usually this is how materiality applies, right? Materiality is also tied to risk anyway, and the nature of the entity I told you before. Okay, so usually there's something we call performance materiality, which is typically 50 to 75% of materiality. This one is used to reduce the risk that aggregate misstatement exceed materiality. So let's say that debtors figure that I told you that it's what 3 million, right? It's below materiality. But let's say if I take 75% of my original materiality, is it up to that? If you put some small things together, do they exceed the 75%? Do you understand what I mean? So sometimes yes, the thing overall is not material. But if I start putting small things together, do they exceed that level? So performance materiality is a percentage of the overall materiality. Do you understand? About 50 to 75%. It depends on the question as well. In real life, we have a way we do it. Sometimes our audit software itself calculates it for us. But in exam, if there's a need to use that, we are trying to reduce the risk that the aggregate misstatement exceed the materiality. So if we do this, that small misstatement, if we put it together, does it exceed the materiality level? If it does, those things must be investigated. Okay, so apart from this performance materiality, we have materiality by nature or the circumstance of the issue that is happening. Okay, so small amounts are material if they affect compliance with laws. Let's say something that affects a major law in Ghana, it is automatically material. Things that change profit to loss, material. Things that hide fraud, they are material. Directors' fees, material. Things that affect key ratios or bonuses, material. Things that affect bond covenants, they are material. Things that involve related parties, they are material. Do you get it? So these are qualitative materiality thresholds that are not number related, but they are material. So when you spot any of these things, you have to comment on the materiality. For instance, a 50,000 Ghana cedis bribe is material by nature, even though it's below the quantitative threshold. Does it make sense? Did it make sense to everyone? So far as it is bribe, it is material. You have to, because it leads to non-compliance. Are we learning something? Okay. So let's see how we deal with this. So let's say if you are doing advanced audit, it's all about commentary. So you can say materiality is based on 5% of profit before tax, which is what? Let's say 500,000, right? That's 5% of this. This amount will guide the extent of testing and identification of significant risks. Very good. Audit is all about how to present the answer. So I'm showing you how to do that. If it's materiality by nature, how do you deal with it? You can say, although the related party loan is only 150 cedis, it is material by nature due to IAS 24 disclosure requirement. Perfect. Are we learning something? Are we learning something?
In that sense, doesn't mean it wasn't disclosed.
No, it has been disclosed, but you are doing your matters. You have identified the matter as very important.
Okay.
Do you understand? So sometimes it wasn't properly disclosed. They will tell you. So you still have to say that, yes, even though it's 150,000, it's below materiality, but it's still important, right? Because it's by related parties. Okay, so it can be by calculation. That's what I've shown you. It can be by nature. It can be by implication. I get it. So we can just say that, oh, items above 200,000 threshold present a higher risk of material misstatement and actually require what? Increased substantive testing. Very good. So what have you learned about materiality so far? What have you learned about materiality so far? Okay.
A lot. So I was going to ask this. So the what requires substantive testing, if I can recall from the scenarios you've given, is when the thing is not like a highly risk in nature.
No, things that are, yes, things that are mostly risky in terms of controls, I getting it, would mean that you place more reliance on substantive procedures. Do you understand? Because if my control systems are not good, then there's no need to test controls because I've already drawn my conclusion there that it's not good. So I have to do more substantive testing.
Yeah.
Does it make sense? But if
Yeah.
my controls are good, then I have to do minimal substantive testing because I've already concluded that your system is good. So I don't have to test so many things. Now, this is something that you don't usually see, but they examine it in secret, right? This is rapture. We call them large, unusual, and questionable items, LUQs, right? So these are transactional balances that stand out because of their size, nature, timing, frequency, or lack of explanation. Okay, they often signal higher inherent risk or possible fraud or errors, right? So examiners love this point because it shows professional skepticism. And ICA now, one of the key requirements of your syllabus is professional skepticism, right? So items that are material in value, we call them large items, right? In terms of the materiality threshold, prior year balances and expectations. Why do they matter? Because these large, unusual, and questionable items, are you getting it? Could have high possibility of misstated amounts, could significantly affect the financial statement if they are incorrect, and they need detailed substantive testing. For example, a 12 million receivable booked near the year end is significantly above the materiality threshold of 2 million. You see, we've used that 2 million consistently. And this large balance increases risk of material misstatement and requires confirmation and impairment testing. Also, apart from large items, you can have unusual items. Transactions that are not in line with the normal business operations, including new types of transactions. Let's say the person bought cryptocurrency. Do you understand? Rare and one-off events. So sometimes you have what? Let's say they purchased a whole factory just once in 5 years. So look at somebody's revenue. Okay, look at this. His revenue was 20,000 in 2024. Now you check 2025 account and revenue is 2.5 million. What is happening? Does this tally? You see, there's an unusual item somewhere. Who has noticed? From 20,000 CDs to
Yeah,
2.5 million. This jump is so
2.5.
crazy.
Yeah.
It's too crazy. So between this and this, something has happened. So I can say, okay, please give me the schedule for 2025 revenue. So you check January, you realize that January sales was what? 15,000. Okay. You check February, sales was 10,000. You check March, and then you have what? 2.4 million in March. Then you can say, why
Why
from
the
this
sudden
2.4
jump?
million? Then so we had a contract to construct a factory complex for one entity in France, and that is why we have this in terms of the revenue. Do you understand? So when they are unusual items, they require questioning. Okay, and even these things have unusual relationships between the accounts. Okay, because why would it matter? It may indicate an error, maybe misclassification or manipulation in the accounts. So your eye has to be there. Okay, and mostly these things involve complex accounting or maybe management judgment, like construction contract, and they are often linked to fraud or red flags. I'll come and show you how to actually use financial statements themselves to do audit. Like they've given you financial statement, road ratios are required for what? Sometimes you need to calculate a current ratio. This one like this, I could have calculated what? The gross profit margin to check its risk, because gross profit margin is tied to sales and cost of sales, right? So what is the cost that was associated with this? The cost increase in direct proportion to the sales revenue. If the cost increase more than the revenue, what is the risk that is tied to it? Does it make sense? These are all techniques. So once you get these techniques, you realize that advanced audit is not as scary as people think. That's why I hardly teach audit. It's been years. The last time I taught audit was 2020. Yeah, I think 2020 or 2019. So, for example, you can say a sudden 35% increase in revenue in December, despite stable monthly sales earlier in the year, is unusual and may indicate cut-off issues or revenue manipulation. You see the thing? So that sudden 560% increase in revenue in March, I get it. Do you remember the example I gave? Or 2000% increase in March, despite stable monthly sales earlier in the year, is unusual and may indicate cut-off issues or maybe revenue manipulation. You see how you answered this? Yes. So sometimes these things are there. And questionable items are items that appear suspicious, or they lack justification. They didn't give you enough information, or they contradict expected patterns. So in real life, when we go for an audit, we say, oh, please, can we have your budget? So we check your last year budget. You put this thing in there, right? This year, the thing, it doesn't follow the pattern like that. Then you ask him, so due to the COVID, this and this, so we had to go online and all that. You're like, okay, now it's starting to make sense, right? But some things are done, you don't have documentation for them, unsupported journal entries, maybe round number postings, items were booked at odd times, weekends, late night. Why? Do you understand? So they are questionable items. related party transactions, they didn't approve it. So there was a not-for-profit organization I was working. The man of God will just come and tell you that, oh, you know something? Give me 20,000 CDs. I want to buy minerals for my visitors. You tell them, daddy, we have to approve this, or you have to sign me, my own money. Why do I have to sign? You say, okay, no problem. This man will go about when you are doing reconciliations and you tell them, the man of God came and he said, we should give him 20,000. He didn't sign, but we wrote a note. You say, me? When? Me? When? I'll curse your whole family. You serious? Oh? Hey, accountant, bro, chairman. Easy. Are we okay? So these areas are very important because of fraud or management bias, and they require professional skepticism and the rest. Now, we spend so much time on materiality for a reason, because that's where people have their problems. Okay. So when it comes to large and unusual questionable items, sometimes you can tell the examiner, this transaction appears large, unusual, or questionable, and therefore represent a significant risk of material misstatement requiring further investigation, or they should investigate it further. Okay, that's all. Are we okay? Now let's come to the accounting issues. Okay, so in the AAA exam, the examiner expects you to identify the exact accounting issue in the scenario, link it to the specific IFRS or IES requirement, comment on whether management's treatment appears correct or risky, and state the audit implication or risk of material misstatement. Did you get it? So maybe you can write it down. You can write this down. Please write it down. If you are done, you tell me. Then we move to the next issue. Then we take a question, then we close. It's almost 6. Please, have you written it down? Have you written it down? Or just take a shot. I think that will help. We have less.
We're taking a shot.
Okay, good. So usually when it comes to accounting issues, identify items that are new, complex, or unusual, involving estimate, they are significant in value, maybe based on judgment, affected by new accounting standards, related to revenue, leases, provision, fair values. You know them. Those things require judgment, and they are usually complex. Like the company has capitalized 8 million of R&D expenditure, research expenditure, right? So you can link to the relevant accounting standard, right? So identify the exact rule being broken or tested. So IES 38, intangible assets. So research must be expensed, development must be capitalized if only the pirate criteria is met. Something like IFRS 15, revenue recognition must follow the 5-step model, COPA. Contract identification, there must be performance obligations identified, right? You must have the price of the transaction. Are you getting it? Allocation of the transaction price, the recognition of the revenue. Leases, the lease must be recognized on the balance sheet, a corresponding liability and an asset. Provisions, there must be a present obligation, right? It must result in an outflow of economic benefit, reliable estimates. Financial instruments, are they measured at fair value or the expected credit loss model? Are you getting it? Inventory, deferred tax. You must know all those things, at least the basic ones. At your level, that's why the papers are labeled paper 1.1, paper 2.1, or 2.2, 2.3. They are labeled. So corporate reporting comes before advanced audit. That's what people forget. But you ask people for the best combination of papers, they say, oh, go and do audit and tax. I think it's the wrong combination. Audit and tax are not the right combination. Corporate reporting and audit are the best combination, because auditing is accounting. You are reversing the accounting that was done. So anybody who does reporting, audit becomes easier because you are testing what you did. Do you understand? Anyway, that's just by the way. So all you have to do is assess whether management treatment is appropriate or risky. Okay, so this is where you state whether the treatment appears appropriate, aggressive, incorrect, lacking evidence, high risk due to judgment. These are all terminologies, or let's say What word do I need to use? The vocabulary that I'm adding to you. So you say that, oh, what management has done looks appropriate, but this area is still material, or it looks aggressive in their revenue recognition, or it's lacking evidence, or it's incorrect. So management treatment appears risky because capitalizing research costs is prohibited under IAS 38 unless the project has reached the development phase with demonstrable viability or there's technical feasibility. You see how this is. I'm also showing you how to present answers. That's the main reason why I am doing this. But I hope it's helping.
Yeah, it's helping.
Yeah, so it's the vocab, the brofo. When it comes to audit, the brofo no. Some people know the thing, but they don't know how to express themselves. That's why I'm coming in to help with this, right? So management's treatment appears risky because capitalizing research costs is prohibited at IAS 38. The time is short. That's why I'm using what I've already written. Me, I like writing, so but the time, so that we can cover everything. But I hope it's still helping. So management's treatment appears risky because capitalizing research cost is prohibited under IAS 38 unless the project has what? Met the development criteria. Very good. Then you state the implication on the audit, right? This will lead to what? Increased risk of material misstatement, maybe a possible misclassification, a possible overstatement or understatement, right? Need for additional disclosures, maybe potential impact on the what? Audit opinion. So this may create a significant risk of material misstatement if incorrectly recognized or disclosed. Very good. Okay, so look at this. The entity capitalized 8 million of research expenditure. So IAS 8, the 38 requires all research costs to be expensed. Only development costs meeting the strict criteria, then you state the criteria, can be capitalized. So management treatment appears what? Highly questionable, increasing the risk of overstatement of intangibles. You see how I answered that? This may create what? A significant risk of material misstatement if incorrectly recognized or disclosed. Additional testing over this stage of the project is required. Look at how I presented this. Does it look real? Does it look nice? If I write this, do you think they will score me?
Of course, they will score you.
I hope you are getting it. So you tell us the issue, what the IFRS says, whether what they've done causes lead to risks. Are you getting it? That's the implication. Are we okay? And if this thing should go on, what would it do to our audit? That's all. Some people end these kind of questions here, but I think it's not enough. So look at this example. Revenue was recognized on dispatch instead of transfer of control. So revenue of 12 million was recognized when goods were dispatched. Is revenue supposed to be recognized when goods were dispatched? Control must transfer to the person. Meboa. So is it the right treatment? Is it the right treatment? Is
No,
it the
because
right treatment?
no, because the other party has not received it.
Yes, that's what I'm saying. But if this person has recognized the revenue, there's also an ethical implication. He wants to bloat the revenue. Why? There may be a potential that these people are going for a contract. I get it. So apart from this, sometimes you can say ethical implication. Now the account. It enriches your answer. So revenue was recognized. That's the issue. What was wrong? That's the first thing you always start with. What does the IFRS say? Revenue is recognized when control transferred, not necessarily on dispatch. What is the risk assessment? This is a high risk area as revenue is susceptible to manipulation. Okay. What is the implication? This may lead to premature revenue recognition, creating a significant risk of material statement and requires what? A cast-off testing. You see how this was. So these are mostly risky areas that they are going to give you. Something like a lease that was not recognized on the balance sheet. A 5-year warehouse lease has been treated as an operating expense. Very wrong. According to IFRS 16, it requires what? A right of use asset and a lease liability for almost all leases, except low value leases and short-term leases, right? The treatment is likely incorrect. You see the vocab I was giving you. Understating assets and liabilities. What's the implication? This creates a risk of material misstatement and requires recalculating the right of use asset and lease liability. Very simple. Provisions for legal claims. Remember, contingent liabilities. So you see these same areas I'm giving you in all the questions. These are always the areas they are working around. Provisions. Management has not recognized a provision for a lawsuit with a 70% probability of loss. 70% is more likely than not, right? Probable. we recognize provisions when they are probable. So you are going to say IAS 37 requires a provision when the outflow is probable and measurable. Are you getting it? This non-recognition is inappropriate. This may understate liabilities and expenses, creating a risk of material restatement, requiring legal confirmations. Do you understand? Are we gradually getting the flow? Are we gradually getting the flow?
We are getting it, but we have to
Yes, sir.
sit. We have to sit to get it properly.
Yeah, so you practice. So once I have given you this, every diet, matters and evidence comes in one way or the other. You take those questions and try to apply what I have taught you. That's how you become good, right? That is it. Bruce Lee made a statement. He said, I do not fear the man who has practiced 1,000 punches once, but I fear the one who has practiced one punch 1,000 times. That's the best way to build hand-to-eye coordination. Practice that thing over and over again until it becomes second nature. Audit is the past questions. I won't lie to you. You solve them, you relate. You solve them, you relate. You start spotting the gaps and the differences. Then you try to tie them together. That is the thing. And you will be fine. Investment property revalued upwards by 50 million, right? IAS 40 requires fair value based on market evidence and valuation by a qualified expert. You see here, you need a qualified expert. So you can go for it to say, okay, we'll need an audit expert, and the audit expert will need this from him. If only you know, if not, you can say we'll need valuation by qualified expert. So this will involve significant judgment and may be biased, right? The implication, an overstatement of assets, may require the use of auditors valuation expert. You see, as I was telling you, something like that. We can look at all the cases. So in the exam, what do we need? Follow the structure. What is the issue? How does it link to the IFRS? Evaluate it, whether it leads to an understatement, overstatement, improper disclosure, presentation, all that, then the implication of the audit, right? This will always score you full marks. Are we okay? So when it comes to risk, what are you going to look for? From the scenario, why is it a risk? How does it affect the audit? We've already talked about some of them. Do you understand? Yeah. So inherent control risk, I won't worry myself. But there's something called fraud risk. When somebody intentionally mistakes due to manipulation or concealment or misappropriation of assets, common areas, revenue inflation, expense understatement, cash or asset theft, management override of controls. So when it comes to business risks, are you getting it? The risk that you are not going to achieve your objectives. All right. So usually things that come from your environment affecting your operations, profitability, survival. And this will have a financial statement impact. Now look at something. You see, you can always use pestle, SWOT, 5 forces, which some people still don't know, that they can use this to identify business risks from advanced audit. Yes, you can. So if you know how to use pestle, SWOT, 5 forces, you can use them. If bargaining, let's say your customers are able to dictate prices for you because there are so many competitors in the industry, that means bargaining power of customers are high. True or false? And if bargaining power of customers are high, then the company is going to lose revenue. If company is losing revenue, it's going to affect profitability. You can calculate some ratios to support this. That because of that, gross profit margin has seen a reduction compared to last year. A significant reduction in profit is a problem that you have a going concern issue. It's one of the indicators. You have to mention it. Audit is still accounting. That's what you must understand. Audit and accounting are the same. Just that audit, you are checking somebody's accounting. So you must understand accounting to be able to check whether what somebody has done is right. Is it making sense? So I'll take some few questions before we continue. I'm waiting.
Yeah, please, I saw cut off. Doesn't really mean audit.
You say you saw what?
Soft. Cut off.
Cut off means something might, cut off means does it belong to the right accounting period? So let's say cut off point means if something belongs to 2024 we shouldn't find it in 2025. If something belongs to 2025, we shouldn't recognize it in 2024. Some companies do aggressive revenue reporting. So let's say a customer wants goods next year, then they come and recognize that in this year to inflate this year's revenue. It hasn't met cutoff. Do you understand? Cutoff goes with matching. So you must match revenue for a particular year to that year. Are we okay with cutoff? So mostly when we are doing audit, we always do cutoff test. Whether the right expenses have been recognized this year or the right revenue has been recognized in the appropriate year. Makes sense?
Sir.
Yes, please. Okay, so we are saying that you can use PESTEL 5 forces SWOT to identify business risks, and business risks usually have a financial statement implication. So, for instance, the business risk is that they are facing technological challenges or inventory obsolescence. That is it. But this business risk has what? A financial statement implication. It can lead to a risk of material misstatement, right? That if your inventory is always becoming obsolete, then there's a potential that inventory is measured wrongly, or because there's a potential that you're still carrying them at cost instead of NRV. Because if your inventory goes out of fashion, it will be now costing lower. Does it make sense? Does it make sense?
Yeah.
There is that you are not able to keep proper records of your customers. Definitely, you have a lot of bad debt issues because you can't even check those who are owing you. Bad debt will likely be misstated. Do you understand? And it will affect the receivables balance. Do you see the thing? So all these risks that you are looking for, mostly they are tied to either something being wrong or it's leading to a going concern problem, right? Example, if you have loss of key customers, market downturn, going concern, even, do you know that if you have compliance and legal issues, right, it can even lead to going concern problem because government can shut down your business. You have to disclose.
Yes.
These are the things you're actually looking for. If you spot those things, look at the implication on the financial statement. If the company has refused to pay a penalty because they were damaging the environment, then they have a going concern problem. If there's a media outcry that this company can even inform these stakeholders like the EP and the rest to come and shut you down, or you pay huge penalties, which can affect your business. Is the auditor aware of that? Does it make sense? Does it make sense?
Yes, sir.
So instead of solving questions, I actually came to teach you. You understand? So let's take a simple example. We'll close right now. So risk. The company entered a complex multi-element revenue contract with a customer worth 20 million. Why? Why is this a risk? I get it. Complex contract increase the risk of applying IFRS 15 incorrectly because there will be multiple performance obligations. Revenue is also a significant fraud area. This may lead to overstatement of what? Revenue and incorrect allocation of transaction price. Significant risk of material restatement requiring detailed contract review. Something like this. Do you understand? So there are a lot of them. I mean, a lot of them. So if you are writing a risk, right? Identify the risk, explain why it is risky, and explain the impact on the financial statement on the audit, like misstatement. So incorrect recognition, incorrect misstatement, that's understatement, overstatement, will require extra work. You have to state it. And this will give you full marks. All right? Good. So an area that requires estimate and judgment, right? So you tell the examiner, right, where is there an area of judgment or estimate? Why is it risky? Maybe it's due to uncertainty, bias, or lack of evidence, how it affects risk of material misstatement, and whether we need an expert. So when we talk about estimate, we are talking about what? Fair value estimate, useful life of PPE, warranty provisions, deferred tax computations, expected credit loss, impairment, provisions, actuarial estimates under IAS 19, and revenue estimates. So these are all standards that require estimates, right? So what do you consider as an auditor when it comes to estimate? Is it reasonable? So that estimate that you're looking at, is it reasonable? Are you getting it? Does it involve bias, like low impairment, high value assets? Is there evidence to support those assumptions? Those assumptions that you have, Can it significantly change the estimate? Is it accurate? Are you getting it? So always add things like high estimation uncertainty increases this risk of material misstatement. This may require specialist support. It requires a detailed testing of assumptions and model. Are you getting it? So management assess goodwill impairment using future cash flow projections with a 10% growth rate and a discount rate of 7%. This involves significant assumptions, right? Like growth rate, discount rate, terminal values. The risk is that the growth rate may be overly optimistic. Small changes in discount rate may significantly affect valuation. What is the implication? High estimation uncertainty increases risk of material misstatement. This area may require specialist valuation support and sensitivity analysis. It doesn't mean you should write this. If you can, I know a lot of you cannot remember this, but if you've seen things that are based on cash flow projection, definitely it's based on some specific assumptions, right? So what will happen? You require a specialist to actually confirm that. True or false? True or false?
True.
True. You just tell the examiner. That is all. Are you getting it? So any area that involves estimate, you say what? This area involves significant management judgment and estimation. Are you getting it? And assumptions relating to this. High estimation uncertainty increases this, especially assumptions that may be biased or unsupported. This may require specialist involvement and a detailed testing of management. That's all. So when it comes to going concern, all you have to do is what? Check going concern red flags, right? So like recurring losses, negative cash flows, net current liabilities, debt covenants that they are breaching. Are you getting default on repayment? When it comes to operations, they've lost major customers. We talked about these things, right? So the things that are happening in the business environment that can collapse the business. The company has a major court case that can lead to a closure of the company's division, or they rely too much on short-term financing. I mean, going concern, we'll come and look at questions on going concern, but these things too are matters that you have to what? Are you getting it? So use these lines in your exam for full marks. Like this require detailed going concern evaluation in line with ISA 570. This may need additional disclosures regarding material uncertainties about their going concern. Auditors may need to include an emphasis of matter paragraph or modify the opinion. This increases risk of material misstatement and professional what skepticism is required. These are some lines you can add to enrich your answer. Are we okay? So for example, a loan covenant breach. So the company breached a bank covenant requiring what? Interest cover greater than 3. Actual interest cover is 1.8, right? The bank has not yet confirmed whether it will waive the breach. The risk is that the loan may become repayable on demand because you have breached this, and the company may not have the cash to repay. That's a liquidity crisis. This is a business risk. But however, there's material uncertainty exists regarding their going concern. That's how you are going to write this, right? And there's a need to obtain written confirmation of the covenant waiver. And if not obtained, we can issue a possible modified opinion. Very good. And you see how these things tie into the answers. Mostly we lack these techniques. That's why it's like audit, you understand. It's like everything in audit has become theoretical, but it's not supposed to be theoretical. When you understand the theory, this is how we actually apply it. I hope you learned something. Let's say the company has a net cash outflow, right? They've made continuous losses for 3 years. The overdraft limit is almost fully utilized. Business risk, right? So what is the risk? The business may not have sufficient cash to meet obligations. The need for cash flow forecast, which may be unreliable, right? Because this one is already facing cash problem. So this requires stress testing over management forecast. We must obtain evidence for what their financial plans, cost-cutting strategies, sales recovery, and likely the need for an emphasis of matter paragraph. Now look at this. I know some of these things you might not remember, but my only advice to you is that anytime you see something concerning business not having money, things that can lead to its collapse, all you have to say is that management should do a proper test. I get to know, or check the material uncertainties over their going concern, right? And obtain evidence for that. That is all. Then the auditor will issue an emphasis of matter paragraph because this is a matter that requires emphasis. That's all. I hope it makes sense. So me as a student, I don't comparing us here to ACCA or SEMA standard. I know Ghana, you brought for you week kakra. So you just use your normal language. Let them understand what you are saying. That's all. And you get the mark. Even if your brofo is not so good. Are we okay? So, okay. Now, ethical issues, I've already told you about that. Anytime something happens, it's either what? It is intentional or unintentional. So anything that happens in accounting, always have that in mind. If it's intentional, it leads to a breach in objectivity and integrity. Why? Because maybe it's a self-interest, self-review, all those traits, you know them already, right? If it is unintentional, that means it's a competence and due care problem, which may be due to traits. So anytime there's a competence and due care problem, because it's ethical, you don't know why the person did it unless they give you more evidence. So if it is due to competence problem and due care problem, that means it's due to lack of training or insufficient training, insufficient resources, insufficient information, insufficient time. This is why somebody may not be what competent enough or will not exercise reasonable skill and care in a particular scenario. Are we okay? So you usually state that. That's all. So then sometimes you have to look for evidence. When it comes to evidence, okay, I won't talk plenty, but when it comes to evidence, you are going to talk about what? Usually we use that at three, okay? Evidence comes in the form of documents. So when it comes to documents, check vouchers, right? A copy of a voucher, a copy of board minutes. So always for evidence, you can say a copy of something, right? A copy of the board minutes, a copy of what? Maybe the invoice, a copy of what? Maybe the day book or something, right? The assets themselves, you have to do physical inspection. So a copy of, I say a copy, the asset itself, right? Inspection of the asset, that is evidence. Directors, they have to provide you minutes or management representations, right? Then accounting books, you know the various accounting books, right? You can mention that a copy of the ledger or maybe a submission of the ledger for you to check the ledger. Third parties, confirmation from third parties. Third parties, you are talking about what? Your banks, right? Your lawyers, your valuer, your receivables, your payables. Sometimes you can get evidence from them. Are we okay? Are we okay? Are we okay? Are
Yes.
we okay?
Yes, please. Sir, please, will we have access to this material?
This one is my audit textbook. Oh,
Oh,
so
okay.
unless the book is ready, then I will give you access. I'll get you copies. So let's look at this. So Setters Stores Company is a large retail chain that operates numerous stores across the country. Your firm is conducting the final audit for the year ended 31st January 2025. The draft financial statement showed total assets of 300 million cedis, revenue of 620 million, and profit before tax of 47.5 million. The company has recently undertaken two significant strategic initiatives. Initiative 1, so they will have exclusive distribution rights on 1st September 2024. Setters Stores Company acquired an exclusive distribution license, meaning an intangible asset, right? For a very popular branded soft drink. This license costs 50 million and grants Setters Stores the sole right to distribute this soft drink within its stores for a period of 5 years, right? The 50 million cost of this license has been recognized as an intangible asset in the dry financial statement position at the year end. So what is really happening here? An exclusive distribution license, popular branded soft drink, right? And it costs 50 million. And they have the sole right to distribute this soft drink within their stores for a period of 5 years. They have recognized it as an intangible asset in the draft statement. Initiative 2, property divestment, right? So they made a strategic decision to divest a number of its older non-core retail properties. These properties were immediately classified as asset held for sale. So the whole thing is that if you are not even sure, at least the basics, like the recognition criteria, you must know it so that you can support it with the question that you are talking about, right? So in the draft financial statement, they recognize what? 26 million. However, in accordance with IFRS 5, they were remeasured to their fair value less cost to sell, which was determined to be 24 million. This 24 million is the amount recognized in the statement of financial position at 31st January 2025. So the notes to the financial statement explicitly states that the company expects all these properties to be sold within 1 year from the date of classification. You are currently reviewing the audit working papers to these two items. As the audit manager reviewing the working papers for the final audit, I get to prepare notes addressing the following, right? 1, explain the key accounting matters you would consider in assessing its recognition and valuation. Recommend the audit evidence. You remember, matters and evidence. The audit evidence you would expect to find in the working paper file to support the appropriate accounting treatment of the license. B, when it comes to the properties, right? Explain the key accounting matters for the property in terms of classification, measurement, and presentation. Recommend audit evidence. So matters and evidence. So look at the style. Distribution license. The final audit is nearing completion and you are reviewing the audit working papers. The draft financial statement recognized assets of 300 million, revenue of 620, and profit before tax of 47.5. Do you know the reason why they gave you this in the question? This is just a recap. Why? Because of materiality. You remember, so matters. The amount capitalized as an intangible asset is material to the statement of financial position because it represents 5% of total assets. Do you get it? Intangible asset, financial statement where? Balance sheet. So far as you calculate it, and it is a percentage of what? That, then it is material. According to, you see, this was materiality. From there, the next thing I come and do is what? Come and talk about what the IFRS says. You remember? So according to IAS 38, an intangible asset is recognized in the financial statement if it meets the definition of an intangible asset. That means it is what? Separable. Remember, identifiable non-monetary items. It is separable. Probable that future economic benefits will flow, and if costs can be measured reliably. Management should be able to demonstrate the economic benefit that has been or is expected to be derived from the license. This is what the IFRS says, right? Then I go forward. As the license has a fixed term of 5 years, it should be amortized over that period. However, it appears amortization has not been charged as the amount recognized in the year end is the original cost of the license. There's a potential overstatement of assets on the financial position and the understatement of expenses, possibly to enhance the asset base or profit position of the company. Amortization of this, right? You can calculate it yourself. Then you say ethical implication, if you must. Then you say that this potential issue may have been what? A competence issue or integrity or objectivity issue. If it was due to a competence issue, this may be the reason. Maybe lack of insufficient time, insufficient resources, insufficient training. If it was due to objectivity and integrity problem, then it may be a possible self-interest rate. Then you are done. What is the evidence? They must give you a copy of the distribution license, confirming the 5-year period of the license and the cost, right? A copy of bank statement as evidence of payment made, the result of the discussion with management or the board, right? Including any reasons for the non-amortization, copy of the sales forecast in relation to the soft drink to determine the future economic benefit, right? If you can't remember all this, know that every transaction has you bought, so it definitely has a document. Test that document or require or request that document. Definitely, if they want to acquire a distribution license like this, the board would have discussed it, a copy of that board discussion or minute. Do you understand? It's all evidence. You are looking for evidence. So a copy of something. So always like that. Did you get a style? So asset held for sale, right? What are we looking at? The matters. If you look at it, the properties classified as asset held for sale are material to the financial statement at the year end, carrying a value of this. And this is 8% of total asset, has exceeded the 5%. Is it material? Is it material?
It's material.
It is material. So you now go to the accounting issue. Asset can only be classified as held for sale if the conditions referred to under IFRS 5, are you getting it, are met. What is it? So you can use Palm 12. 1, there was a plan to sell the asset. That plan is not going to change, right? The asset is available for sale. They're actively looking for a buyer and it is marketed actively within 12 months of sale. If this criteria is being met, then the asset should be classified as held for sale. So if you state the criteria, you now come and look at what it says, that it requires the asset held for sale as measured at the lower of what? Carrying value and fair value less cost to sell or NRV. This appears to have been correctly accounted for. So it doesn't mean that matters and evidence always there's going to be a mistake. No. Sometimes they've done the correct treatment, but they're asking you for matters. You still have to talk about it. It's not only the wrong entry spare. Even if it's correct, sometimes you must still check what the IFRS says and say, this appears to have been correctly accounted for. right? This asset should not be depreciated after being classified. The risk could be that the asset is wrongly classified as a non-current asset or further depreciated. Remember, risk is also a potential risk. There may be a risk that is potential risk. Do you understand? So risk can be actual risk or perceived risk. So yes, they've done it correctly, but what is the risk there? It may be that they still recognize it in PPE, which it shouldn't be there. There should asset held for sale are relatively short term, like they are going to be sold soon. They are not supposed to be depreciated. What if they are depreciating it? There's a risk there. Are we okay? So you state that. The risk could be that the asset is wrongly classified or further depreciated, which could understate the profit or overstate expenses. What is the evidence? A copy of board minutes at which the disposal was agreed by management. Remember, there's a plan to sell. The plan is not going to change. That plan, can I have a copy of it? They said you are looking what? You are looking for somebody to buy it, right? That marketing advert that you do you have it on file, right? Definitely, there may be correspondences from the prospective buyers. Can we have a look at it? Management would have made some calculations of fair value, less cost to sell. Can we check that estimate? These are all evidence, right? But this one, what is a potential ethical issue? If they've wrongly classified it, then it may be due to what? Other intentional issue, objectivity and integrity breach, or unintentional competence issue. The person didn't know the standard very well. But since they did it well, it is not mostly a competence issue. Do you understand? So that brings us to the end of our session. I know today we didn't learn anything, but I hope it was worth it.
Yes, you've done well.
We did learn something.
Media, I don't know anything about audit too. I'm now crawling, so.
Hey.
All right. So I'll see you. When is our next audit meeting? I think then we'll look at either ethics or maybe, I don't know, the topics. I mostly like to teach the confusing topics, right? The areas with the marks. Maybe audit opinions. I don't know. But let's see how it goes. May the Lord be with you.
And be with us forever.
When is our next corporate reporting? When is our next corporate reporting class? I mean, our dawn sessions. I don't even remember. All right. So I'll see you. I think it's tomorrow or something. I don't know. But